Hello accounting grade 12 learners and welcome to today's lesson. In this lesson guys, we'll be revising June exam paper 1. So it means now on your side you definitely need to ensure that you will watch this recording up until the end. So guys, we are going to start with question 2, the cash flow statement. As you can see, the mark allocation for that question, it is 30 marks and learners were given 30 minutes to complete the question. So what we have Piper Limited, the name of the entity. So we're provided with extract from their records. Their financial year ended 28 February 2026. So it means now guys, our current year will start when? From the 1st of March 2025 up until when? The 28th of February 2026. So it is very important guys always to check your accounting period. 2.1, what are we required? Before we can read what is required guys, please make sure that you like. Please like my videos, you share. If you are on TikTok, please repost my videos, you follow me. And then if you're on YouTube, please subscribe guys, subscribe. That will help me to create more educational videos that will assist you as well. All right, thank you. So here we are required on 2.1 to prepare the cash flow statement for the year ended 28 February. Please as well show calculations workings in brackets to earn part marks. Always guys, in accounting, just like any other practical modules, practical subjects, you always need to show calculations so that you can get those extra marks. So what do we need firstly guys to complete the cash flow statement? 1, the income statement, the current year's income statement. 2, we need the statement of financial position, also known as the balance sheet, from the previous year and the current year. So in information A, we have extract from the income statement for the current year. B, we have extract from the balance sheet on the 28th of February. So we have the balance sheet from the previous year and the current year. Exactly what we need. So as you can see on information C, we have share capital and dividends information. So we'll go to that information when we are dealing with share capital and dividends. D, we have the fixed assets. Let's check if we have any other information. No. All right, so let's get started guys. So as well, we are also given the answer book. Always check the answer book before you can answer the questions, because mostly on the answer book, some figures that will be populated, they will be given. So 2.1, here's the answer book guys. We have everything almost given there. On top, the name of the entity, Piper Limited. We also need to indicate the name of the statement. We're preparing the cash flow statement, the period for the year ended 28 February 2026. So before we can start with our example again, we need to highlight why is it important to prepare the cash flow statement? What is the purpose? What is the main aim of creating the cash flow statement? 1, to track the movement of cash. Money coming into the business, the inflow. So you prepare the cash flow statement to determine where is this money that we are receiving coming from. So you are trying to determine your source of income. Where is it coming from? And then as well, you are trying to check your cash outflows. Why is money leaving the business? Why are we making payments? So you need to prepare the cash flow statement to track the movement of cash. All right, so the cash flow statement is divided into 3 activities. 1, the cash flows from operating activities. 2, it will be the cash flow from investing activities. 3, the cash flow from financing activities. So it is very important guys to know what we record under cash flows from operating activities. So under cash flow from operating activities guys, I want you to think about the main activities of trading businesses, businesses that buy and sell goods. What are their main activities? 1, is to sell goods and services, is to sell goods, is to sell products. So under cash flow from operating activities, we record the sales of operating businesses, sales of trading businesses. 2, we record the buying of trading stock. And then 3 as well, we record any outflow of cash as a result of paying maybe your creditors. So the main activities of operating of trading businesses will be to sell goods, to buy goods. Whether you're buying goods cash or credit, at some point you will have to pay your creditors if you are buying those goods on cash. So as you can see, we record firstly the cash generated from operations. The cash generated from operations, mostly for your term 1, you'll be required to do what? To prepare a note for cash generated from operations. But as you can see here, we're already given the figure from cash flow from operating activities, the 1,687,368. So we don't have to prepare the cash generated from operations. So what we record here, guys, here we need to record the interest paid, we need to minus the interest paid. Why? Because interest paid is not an operating activity. This is a finance cost. And then 2, dividends paid. Dividends paid, guys, any information that is associated with dividends, it will be recorded under cash flow from financing activities. And as well, we need to minus the income tax paid. Income tax paid. So that is what we record under cash flows from operating activities. And then we also have cash flows from investing activities. Investing activities, guys, just think about the movement of fixed assets. Are we buying any vehicle? Are we buying any equipment? Are we buying more land? Or are we selling our fixed assets? We here will record the movement of fixed assets. And also the finance asset will be recorded under cash flow from financing activities. But under investing activities, I just want you to think about the movement of fixed assets, of your land and buildings, equipment, vehicles. Are we buying or selling those fixed assets? The movement of those assets will be recorded under cash flows from investing activities. And then we also have the cash flows from financing activities. Financing activities, guys, I want you to think about money. Are we buying shares? Are we repurchasing our shares? Are we getting proceeds from the issue of shares? That movement will be recorded where? Under cash flows from financing activities. So mainly we record the movement of shares under cash flows from financing activities. So we'll also have other items. So let's go to our example now. First part, guys, we need to minus interest paid. Do we have interest paid? Yes, we have interest paid from the income statement. How much is it? It is 187,200. So you go and minus the interest, because interest paid, it is a finance cost. You go and minus interest paid. And then what about dividends, guys? Dividends paid, we minus as well. So I want us to check the information that speaks about dividends. So with dividends, firstly, please let's check the balance sheet there. We have shareholders for dividends. Can you notice that from the previous period, we have the 32,160. So what is that 32,160? The 32,160, if it is there on the statement of financial position, this is declared from the previous period. This is our final dividends from the previous period, which we must pay first to our dividends, to our shareholders, sorry. So our declared from the previous period, we must pay our dividends before even paying the interim dividend for the current financial year. So we go and add there 32,160. So what about now our interim dividends? Here we are only calculating dividends paid for the current financial year. For the current financial year, guys, you pay first you declared from the previous period. Where do you get your declared from the previous period? From the statement of financial position as shareholders for dividends. And then secondly, we record your interim dividends for the current financial year. So let's go and check the information that speaks about dividends. Okay. So as you can see, 1st March 2025 information C, 1st March 2025, the business had 240 shares in issue. 240 shares in issue. And then what happened? The business paid interim dividends of 72 cents per share on the 30th of June. Before buyback, before issuing any shares, we paid our interim dividends when on the 30th of June 2025, which means the only shares that qualified for the interim dividends is the 240 shares that we had in issue at the beginning of the year. Okay, so this is what we need to do. You go and add 0.72 cents times the 240,000 shares. Then you can press your calculator. You will have your dividends paid for the current financial year. Okay, so on my side, I have an amount of 204,960. Okay, and then what else do we minus, guys, from cash generated from operations is the income tax. So the income tax for this example, what I like to do is to prepare the SARS income tax account. The SARS income tax account. So I've opening now a Word document. So I want you to notice something. Please check the statement of financial position, the balance sheet, the last item, SARS income tax. We have at the beginning a debit balance. A debit balance, guys, shows that SARS is owing the business money. SARS is owing us, the business, money. But at the end of our current financial year, we have that 38,940, meaning that now SARS is owing the business. Sorry, we are owing SARS if we have a credit balance. But at the beginning, who is owing who? SARS is owing the business. At the end, we have SARS as a credit balance. We are owing SARS an amount of 38,940. So please note those figures. You can even write them down. So this is what will happen. You go to your SARS income tax account. We have the debit balance with the debit side and the credit side. So with the SARS income tax, guys, if they ask you what type of an account is this, please always say it depends. It depends on what? Whether we are owing SARS or SARS is owing the business. If SARS is owing the business, the SARS income tax will be an asset. But if the business is owing SARS, the SARS income tax will be a liability. So at the beginning of the year, 01 March 03, we have a balance brought down of how much? 17,760. Let me show you that figure again. The debit, the amount owed to the business by SARS. Okay? So on the SARS income tax, what do we credit? We will always credit income tax, the income tax that we have paid for the current financial year. So we'll credit income tax. So where are we going to get the income tax, guys? The income tax from the extract from the income statement. It is given there. 237,888. Okay, so what do we debit? We debit the SARS income tax that we have paid for the current financial year. What we are calculating here. Do we have the amount that we have paid SARS for the current financial year? No. But what we have as well, we have the credit balance of how much? 38,940. It is the credit balance on the last day. If it is the credit balance on the last day, it means now we have the balance carried down. On which side? On the debit side of 38,940. So this is what we need to do, guys, to get the amount paid to SARS. We are going to close off with the credit side with an amount of 237,888, 237,888. So to get SARS paid, the amount that we paid to SARS, this is what we need to do. We take that 237,888 minus the balance carried down and minus the opening balance of 17,760. Okay, and then you should get an amount of 181,188. Okay, so on your side, you need to show these calculations, how you calculated that amount in brackets so that you can always get part marks. So this is what we need to do now. Go to the cash flow statement, open a bracket. So we took the income tax of how much? 237,888 minus 17,760 minus 38,940. Okay, then we have SARS income tax of 181,188. So we minus the the income tax paid for the current financial year. So what we need to do now, guys, take that cash generated from operations minus interest paid minus dividends paid minus income tax paid as well. Then you will have the cash flows from operating activities. Of 1,114,014. All right, and 14. This is for Then we move to the second part, the cash flows from investing activities. Remember I said from investing activities what we record? The movement of fixed assets. The movement of fixed assets. Are we buying land? Are we buying an equipment? Are we buying a delivery vehicle? That will be recorded where? Under investing activities. And then as well when we are selling our fixed assets. So let's check. Firstly, I did check this example, guys. So let's go to information D. What transpired? Fixed assets, equipment was sold at a carrying value of how much? 344,979. We sold an equipment at a carrying value. At a carrying value. That is the amount that we received for that equipment. So we're receiving money, an inflow of cash. We go and record this as proceeds from sale of fixed asset. You can just write fixed asset or be specific to say an equipment at carrying value. Always at carrying value. All right, always guys at carrying value. So on your side, how much is that carrying value? It is 399,979. So as well on information D, a new equipment was bought during the year. A new equipment was bought, an outflow of cash, money leaving the business. Do we have the figure? No, we don't have the value of that equipment that was bought. So what I like to do as well is to create a T account. Let's go and check our fixed assets. Our fixed assets, the tangible assets, we have the opening balance and the closing balance on year 2026. Please note those figures. So this is what we need to do. Go ahead and create a T account. Fixed assets, they have an opening balance on the 3rd of March 2020, not 3rd of March, yes, 2025 at the beginning of the year. We have that balance brought down of how much? Let's note those figures just once, guys. You can pause the video and write down the opening balance of fixed assets and the closing balance. So we have the opening balance of 1,293,312. As you can see, we're already given the balance carried down. How much is the balance carried down? The closing balance. It is carried down on the credit side first. The closing balance is 1,530,394. So we have purchased an asset. If we're purchasing an asset, our assets are increasing. So we have an asset that we've purchased. Do we have the amount? That is the amount that we are trying to calculate. So on your side, you need to ask yourself, what can it decrease assets? 1 is the depreciation, 2 is the carrying value. Okay, so here we are not going to record on the credit side the accumulated depreciation. Why? Because already, if we are taking these figures, the 1,293,312, the opening balance, if it is on the balance sheet, it means now the accumulated depreciation, it is already minused. all these figures that you have, they are at carrying value on the balance sheet, the opening balance and the closing balance. So on your side, what you need, the current year's depreciation to decrease our assets. Here is the current year's depreciation from the income statement, 167,849. We go and decrease our fixed assets by the depreciation amount. So the depreciation amount is 167,849. So what will reduce assets? When we are selling asset, when we have sold. We have sold an asset, if you can remember. On information D, equipment was sold at a carrying value. Here is the amount. So assets are decreasing as well. We have sold. All right. So what we need to do now, guys, we need to close off with the credit side because we already have the balance carried down. So we recorded all the amounts on the credit side. You add those three amounts, the depreciation, sold, the balance carried down, you will have an amount of 2,098,222. 2,098,222. And then what we do, guys, we take that 2,092,222 minus the balance carried down, the opening balance of 1,293,312. Then you will have your new equipment that you have purchased. Your new equipment that you have purchased with a price of 804,910. Okay, so guys, we just need to find a way on how we're going to show all these calculations on the cash flow statements. Remember, to earn those part marks, you always need to show calculations. Okay, so this is what you need to do always. Go to the cash flow statement. We have purchased an asset, purchase of fixed asset. So open a bracket. Firstly, it is the 1,530,394 plus the 167,000 for depreciation 849 plus purchased. So you're adding all the amounts on the credit side the way you did the amounts, all the amounts on the credit side. You can go back and check the amounts on the credit side. We're adding them like we did 979. And then what we do, we minus the amount on the debit side, the balance brought down. You can always go back and check of 1,293,312. Then we have our outflow, our purchase of an asset, an outflow of 804,910. All right. So for this example as well, guys, we need to go and check our fixed asset, financial asset. Can you notice that at the beginning of the year, financial asset, we have 345,600. And then our investment grew to how much? 559,200. It means now we are investing more money. We are investing more money. We are taking money from our business to invest more. Our investment is not maturing, but instead we are doing what? We are investing more money. We are taking money out of the business to invest. So that will be an outflow. Please note those two figures. We have here change in financial asset. Change in financial asset. At the beginning of the year, we only had how much? 345,000 money invested. We decided to invest in more money, 559,200. This is an outflow because we're investing more money. How much is that outflow? 203,600. So what do you do now, guys? You take that positive amount from proceeds of from sale of fixed assets minus the two amounts in brackets. But I can already see that we're going to have an outflow from cash flows from investing activities. So we'll have an outflow of 618,531. So how did we get that amount? Positive, it is a positive 399,939 minus 804,910 minus 213,600. Then you will have a minus, an outflow. So the last activity that we need to record, we have cash flows from financing activities. Financing activities, guys, I want you to think about finance. Are we borrowing more loans? Are we repaying our loan? Are we selling shares? Do we have any share buyback? Are we clear? So let's go and check firstly our non-current liabilities. Non-current liabilities on the balance sheet, as you can see, we have a loan of how much? 1,620,000. But the loan has decreased on year 2026. Can you notice? To 1,128,000. Loan can only decrease when we are making repayments, when we are paying. That is an outflow of cash. Notice the loan has decreased. If a loan decreases, can only decrease a loan when we are making repayments to our loan amount. So we have firstly changes in non-current liabilities, liabilities, because at the beginning of the year our loan amount was 128,000, but now it has decreased. Sorry, it was at the beginning, guys, it was 1,620,000. So on my side, I always like to record the amount that we have from the beginning, which is 1,620,000. The loan has decreased to 1,128,000. This is an outflow. We are paying our loan. We've made significant repayments of how much? An outflow. You show an outflow with a bracket of 492,000. Okay, so we need to check now the information that speaks about shares. Share capital. The first information, guys, already dealt with that information. The second information already dealt with that information. The third point, on 1st September 2025, what transpired? The business issued 60 new shares at 7.60 cents per share. We have issued new shares. We've sold shares. If we are selling shares, which means we are receiving money, an inflow of cash. So we issued shares. We have a share issue, guys. We have issued 60,000 shares at how much each? 7.60 multiplied by 7.60. We are receiving money because we are selling shares. We have an inflow of 456,000. Okay, so let's move to another point. On the 28th of February 2026, business repurchased 21,000 shares at how much? 7 rand and 76 cents. 7 rand and 76 cents. So we're repurchasing shares. Repurchase, we're taking our money to buy back shares. This is also known as what? A share buyback. Because we're taking our money to buy back shares from our existing shareholders. So we don't know the reasons why they are selling their shares, but we are buying back our shares. How many shares? 21,600 at 7.06 cents, 76 cents per share. So you can just write repurchase of shares or share buyback. It doesn't matter. So how many shares? 21,600. Then you multiply by 7 rand 76 cents. So we're buying back shares, an outflow of cash because we're spending money. We'll have 167,616. So guys, what do we need to do now? On your calculator, you can just press minus 492,000 plus 456,000 minus 167,616. So again, we are still having an outflow again from financing activities of 203,616. So this is what you need to do now to calculate the net change in cash and cash equivalent. Net change in cash and cash equivalent. Please take that figure from cash flows from operating activities, 1 million. It is positive 1,114,014 minus the outflow from cash flows from investing activities, and then you minus the cash flows from financing activities. So on my side, guys, I have an amount of 291,867. So hopefully you also have that figure. So under net change in cash and cash equivalent, we record our firstly cash and cash. I'll just write C and C equivalents to save space, guys, but always on your side you write in full. Cash and cash equivalents. the opening balance or balance at the beginning of the year. And then you have cash and cash equivalents. Actually, I don't know what's happening there, my pen. We have the closing balance or balance at the end of the year. So, what is the value of our cash and cash equivalent? At the beginning of the year. So our cash and cash equivalent at the beginning of the year, can you notice that we have bank overdraft? That is the only cash equivalent that we have there, the bank overdraft. It means now we owe the bank an amount of 192,156. We are owing the bank. But we also received money because we sold shares. So our cash and cash equivalent, guys, at the beginning, we have a minus balance of 192,156. It is a minus. Can even write minus 192,156. What happened? Let's go and check. Okay, so I want you to notice, guys, we're supposed to start by checking the cash and cash equivalent under assets. But we started with the bank overdraft, but it doesn't matter. We're still on the right path. Our cash and cash equivalent, we have 16,285. But can you see that we have an overdraft that is greater than the amount of money that we have? We have 16,285. From the bank, we have a minus balance of how much? 192,156. So even if you can take the money that we have from our cash and cash equivalent, minus it from the bank overdraft, we'll be still owing bank. How much? We need to show those calculations on the cash and cash equivalent at the beginning of the year. So you take the minus 192,000, then you plus the money from cash and cash equivalents of how much? It was 16,285. But you will still have a minus balance because your overdraft is greater than your cash and cash equivalent. An overdraft of 175,871. An outflow because we have a minus, we have an overdraft. And then what about cash and cash equivalent at the end of the year? Let's check our assets. Can you notice that we have a cash and cash equivalent of 115,996? But this year, current financial year, we do not have an overdraft. So we just go and record it there. 115,000 from cash and cash equivalents. All right, so what do we need to do now? You can just say minus 175,871 minus 115,996. Negative cancelling a negative, which means we're adding those two figures. You should get an amount of 291,867. But guys, we are definitely done with our example, And thank you for watching, guys. Please make sure that you like, guys. That will obviously help me to create more content. You repost if you're on TikTok, you subscribe if you're on YouTube, share my videos as well. Thank you, guys. I will see you on the next one. Cheers.